right. Well, our next guest speaker is here to tell us how to include crypto in your portfolio. He's a weekly guest speaker on several TV shows and is quoted in many articles like Reuters and Gulf News. He's quite famous. We have here with us today the senior market strategist of the company Exness, Mr. Wael Makaremn. Ladies and gentlemen, Mr. Makaremn.
Thank you. Hello, everyone. It's good to be here and see all these faces. It's good to come back after COVID and seeing all this great crowd. And apparently every one of you is just interested in the way of making money, and everyone is interested in crypto. So I decided to talk today on, it could be a bit more just a way of including your crypto in your portfolio. There are a couple of ways in order to do it. Since all of you here are interested in crypto, so definitely we shouldn't be speaking about benefits or what are cryptos, or just giving a certain definition. So now we're just going to highlight on the things that you have to consider to decide what's the portion or what's the percentage allocation in your portfolio that you have to take. And also the ways of investing in crypto. We have multiple ways, which one could suit your profile better. And then we're going to talk a little bit about Bitcoin for technical analysis, and we conclude. So I just need a clicker. Oh, perfect, thank you. So first, there are a couple of things that you have to consider when deciding on your portion of crypto investments. Many advisors around the world, especially those on the street, they just advise investors to not go over than 5% in their crypto portfolio. But definitely this is not a recipe for everyone. There are those who are interested in cryptocurrencies more than stocks, those who don't believe in holding any fixed income, so they want to go into more riskier assets. They can prefer to choose stocks and cryptos. Some, they have cash equivalents. So it depends on the asset classes that you're having, and cryptocurrencies are fitting inside this old structure. So initially portfolios, they used to have stocks, commodities, cash equivalents, and real estate, fixed income. But now we're into a more step. Cryptocurrencies are entering the different funnels, through different funnels. Some are just holding actual crypto, others they're doing it through ETFs, through stocks. So what matters is that crypto is there, it's becoming more known, it's becoming more adopted among the institutions, among investors. Retailers, definitely they're there. So this is how it's evolving. So what to consider? First, your risk appetite. So many people, they can't afford to go into risky assets. So they have to make sure, in addition to cryptocurrencies, they have some other assets in their portfolio in order to merge. What you have to make sure is to keep a certain balance. So the risk appetite depends on your risk profile. Some people would definitely prefer going into 50, 60, 70, even 80% all in on cryptocurrencies, because they are determined that this is the way of making money, this is the way of ensuring wealth and financial stability. Others, they are in different industries, different sectors, they don't know much about cryptocurrencies, but they definitely want to have a portion of that cake. So they have to start initially, they have to start and test the water slowly, 2%, 3%, and they can go along raising their cap as long as they're getting more knowledgeable about the asset. Balance. What balance are we talking about? We are talking about balance of asset classes in order to ensure we are heading into a proper return within definitely a calculated risk. So we need to lower our risk and maximize our return. And this can be done definitely by going into one asset class at a time. So if I'm all in stocks, I'm all in fixed income, I'm all in cryptocurrencies, when a major incident happens and it hits the full sector, here comes the pain. So if cryptocurrencies in general, they go down, if you're only holding cryptocurrencies, you're going to feel all the losses. While if you're diversified, you're going to be a little bit better off and you can compromise for the losses. Nature of crypto, definitely cryptocurrencies are a new breed of asset classes. They're getting into portfolios more often. Adoption is increasing. 5 years ago, 1 out of 10 used to ask about cryptocurrencies. Now at least 5 out of 10 investors ask about cryptocurrencies every week. So everyone wants to just go after this asset class that could be a proper wealth generator for certain investors. So definitely you have to mind the nature of cryptocurrencies, investment in crypto, while deciding on your portion that you're gonna allocate of your funds. Knowledge. Unfortunately, and especially those who live in the Arab world, they know much about this. Many people tend to invest in cryptocurrencies without knowing what are cryptocurrencies. They are after speculation, they are after the hype. Fine, this guy, the media is highlighting on those who are making millions out of cryptocurrencies, so they are only seeing the upside and they are not seeing the possible risks and downside. They are not working on their knowledge, and this is leading to, unfortunately, heavy losses. So you have to make sure to do your own research, know well what you are investing in, what are the possible risks, what's the possible return when you are investing in cryptocurrencies. So definitely you're not going to go and invest 20% of your total net worth in something that you don't know. You can start entering with a certain trench, and then as things move up, you can just add a little and a little. As long as you're getting more knowledge, you can start diversifying inside the crypto industry, and this is a better way of doing business. Adaptability. You have to adapt when you are already in cryptocurrencies, when you are investing in cryptocurrencies. You have to adapt to all the moves. We all know that cryptocurrencies, they are very volatile, they have good moves, but these good moves, they come with sometimes very high risk. So it's good to make sometimes 50%, 100%, five times, 10 times, but it's also very important to mind the drawdown. So when you are in this asset class, you have to mind, you have to adapt, you have to get familiar with the risk and adapt to it. Age, what comes with age? Usually when we tackle the traditional portfolio theory, or even the modern portfolio theory, we have to mind the age gap, because traditionally stock investors, if you take risk in your early 20s, you can manage to recover if you pass through recession in the first couple of years of your investments. You can manage to recover. So this is why age is very important. But also age is very important when deciding on risky investments. Definitely higher age can't tolerate an asset that's moving 50%, 60% a day, which is a normal sunny day. So that's why we have to keep mind when investing in cryptocurrencies. Forget about the get-rich scheme. Definitely this could happen, but if everyone can make it easily and get rich very easy and through just following the same coin, and everyone is going after the same coin or investing through the same funnel, this definitely is a disruption, and this can't happen. So forget about this. Go for a more steady but surely investment in order to have a better understanding and a better solid ground to hold your drawdowns in your portfolio. So based on these, what traditionally advisors do advise investors is to invest up to 5% in alternative investments. Among these alternative investments could be cryptocurrencies. And this can go higher as long as you are knowing what you are doing, you are more familiar with the products that you are using. You can go as much as you can, because then you have a proper calculation for risk and you have more understanding for the product that you're trading. What to consider? So this is the balanced portfolio, for example. This portfolio, they chose to have domestic equities 53%, international equities 23%, and in the alternatives, 3% it fits, for example, cryptocurrency. This is someone who's very aggressive on stocks and is is a good risk taker. However, others, they aren't ready to take this risk, and they prefer a less volatile or a less risky assets. Those who are willing to take bigger risks in cryptocurrencies, definitely the 3% will be larger and larger and larger, and it can even fit 50% if you are knowing what you are doing. Return to risk or risk to reward, so definitely as long as you're holding heavier risk, you're building up on risk, you're going to end up with higher returns, but watch out for this risk. It could lead to also significant losses. Asset allocation by age. So this is traditionally, when we used to talk about risky assets, we used to talk about stocks, definitely before crypto came in. And safe assets, they are almost fixed income. So this circle is showing, as we grow by age, how much can we afford for taking risks. So when we are in early 20s or 30s, we are more we can tolerate more risk than when we are in 50s, 60s, and 70s. So as we go forward, our percentage or our risk that we're taking in such risky assets will be shrinking by size. What to consider? Definitely not to consider this. No one should just seek get rich quick. It can happen, but sometimes, also most of the times, it doesn't happen. It can happen like maybe 0.1% probability, but you don't want to live on this probability, and you don't want to end up risking most of your wealth, 99.9% losing a chance just to try to get rich fast. So how can we include cryptocurrencies in our portfolio? So this is what matters, the methods that investors can do, or just retail traders. It depends on what you are after. If you are after acquiring these cryptocurrencies to use them as payment, it differs than just going after these currencies for speculation. And as I know, most of the people that are here, or most of those retailers who are after cryptocurrencies, they are after speculation, after the purpose of making money, and not after the purpose of using the cryptocurrency to pay it when you are buying your groceries. So money is after it, making money is after it. So here comes the funnel that you have to use, or you can use that suits you best. So first, you can definitely use the standard way, just subscribe to an exchange, buy cryptocurrencies from an exchange or from a broker. Most of those who have Bitcoin already, or have cryptocurrencies, they pass through this. It's just traditional. If you want Bitcoin, you have to pay the full price of one Bitcoin, you buy it, and then you have it as actual Bitcoin. You store it in your wallet, or you keep it on the exchange, but you are holding the actual Bitcoin. Another way to invest is to consider cryptocurrency ETFs. Lately, we got one that was accepted by the SEC, BITO. It was very clear. It's a tracker. It can track the performance. Also, there are some trusts that were there a long time ago. Grayscale is an example. So these investors who want the exposure to cryptocurrencies, but they don't want to get the exposure of security risk, so this is where they tend to consider ETFs and investment trusts. Investing in companies connected to crypto, like we're talking Coinbase, Square, Nvidia, other companies that were known that they are pro-crypto, or their products, they have a thing for the crypto world. So definitely a better adoption, a bigger performance by cryptocurrencies could also mean that better performance for these companies, and thus their stock could benefit. The fourth way, which is the thing that I'm going to highlight or focus on, is a contract for difference trading, or margin trading, which Exness provides, or any brokers, most of the brokers, they do provide contract for difference. So if you are all after speculation, you are all after the sake of making money off cryptocurrencies, it doesn't matter whether you are holding the actual crypto, or you're just holding the face value of the crypto. So this is where contract for difference trading comes. Definitely it has pros and cons, but we're going to just describe them in a few. Excuse me, this is not working. It's not working. It's not working. Thank you. Even this. So just let me move the slide. Just one. So for contract for difference, let's continue until they change this. For contract for difference, it's a financial derivative where you are actually trading the face value of the asset without actually holding it. So let's take an example for gold. If you are a gold investor and you want to speculate on gold, recently, for example, gold went to above $2,000. So what you can do is just, you have two ways. It's either you go to the jewelry shop, you buy 100 ounces, or to a London Metal Exchange, or you can just go to a broker, open an account, and invest in crypto and contract for difference, where, for example, instead of paying $200,000 for 100 ounces, you just deposit a small fraction of the total value, and if the price of gold goes up or goes down, you will still have the same impact as if you are holding the 100 ounce physically. So this is where contract for difference they come. They are leverage products. They allow you to open positions within fraction of the real value. Definitely those who traded on leverage, they know that leverage can magnify your gains, but also they can magnify your losses. So they are positive, but also they help you with the purchasing power. If you don't have much to invest, definitely shouldn't be investing with a certain risk, but they allow you a better purchasing power for your investment. So if you know where the market is going, if you have good strategy in detecting where the market could be going, if you want to benefit from the volatility, from the fluctuations, you can try contract for difference or head to leverage products. Definitely it can give you large exposure because we're talking of leverage that could go up to 1 to 400, for example, at Exness. Speculate without holding the asset itself, so you no need to hold the actual crypto. You're just trading a financial contract between you and your broker, and it is settled by cash and not by physical or by an asset. Security and safety. So in order to avoid getting hacked or where to store your cryptocurrencies, you don't have to care about this. If you're trading a contract for difference, because it's a financial contract, there couldn't be any, no one can steal this contract, unlike what can happen if you have a wallet and it's hacked. Also for safety in terms of regulation, most of the brokers that they do offer a contract for difference, they are regulated from top-notch regulatory bodies. For example, for Exness, we're talking about SISEC, FCA from London, and different jurisdictions or different regulatory bodies. So also, at least you are investing with someone that if something wrong happens, we can head to the regulatory bodies in order to fix it. Ability of short positions. Many of you know that Bitcoin or cryptocurrencies, they have certain cycles. And in this cycle, the market moves up and it moves down. So if you're not trading on crypto contract for difference, or you're not going for options, you're just trading actually the real cryptocurrencies, you have only one way to trade. It's buy and hold, buy and close, or sell your positions. But you can't leverage on the market going down. However, when you are trading contract for difference, you can initiate a short sell position, where if Bitcoin now is trading at 38,000 and you believe it's going to go to 28,000, at least you can jump on this side and benefit from the market when it goes down. It's not only creating a short sell position, but also hedging. So if you are holding a portfolio for 10 Ethereum, for example, and 1 Bitcoin, you're holding them, the market is going down, you don't want to lose these profits, at least you can use contract for difference for hedging. So hedging purposes, short position purposes, they aren't available when you are trading only the actual cryptocurrencies. It's a fast start. Many are just afraid of opening an account on an exchange or subscribing to exchanges for downloading wallets, initiating wallets. So they prefer to have a better start, a fast start. If you want to open an account for CFD trading, all what you need is a POR and POI, proof of residency, proof of identity, and then your account is set, you deposit, and you start trading. There are no limitations on deposits, on withdrawals. There are no fees on deposits and withdrawals depending on the method. And holding costs, definitely most of the brokers, they do. This is one downside for trading contracts for difference. It has a holding cost. So for example, if I'm holding 1 Bitcoin, there's a cost that I have to pay at every 24 hours a change. However, Exness wants you to hold your cryptocurrencies on their platforms. So they want you to just have this possibility of holding the face value of your cryptocurrencies, not the actual cryptocurrencies, so we don't charge holding costs, which is one of the biggest downsides if you are trading contract for difference. If you trade it with what's called the swap or the holding cost, it's going to pressure you to close your positions if you are willing to trade long term. But at Exness, we don't offer this. We don't charge you holding costs, so this can allow you to hold your long-term position as if you're holding it in your wallet or at Binance, but with a plus that is using the leverage that's being given. Tips to consider when investing in cryptocurrencies in general: don't fall into fear of missing out crowd. Unfortunately, those who belong to this crowd, they end up losing most of their money. They come in late when most of those who bought since the beginning, they are cashing out. Keep your positions and exposure small. As I said earlier, don't go after the get rich quick scheme. Just make sure to do it surely but steadily. Slow profits, small profits, but sure profits are better than just having all in position and ending up in a big risk. If you are willing to go into cryptos, definitely you need to diversify. You shouldn't put all your eggs in one basket. Make sure to diversify your holdings in crypto. There are different types of cryptocurrencies. There are different investment opportunities in the crypto world or in the digital world. So make sure to have a good basket that helps you when the market is not doing well, at least to have a maintained proper risk with possible return opportunity. Do your own research, keep an eye on evaluations. Sometimes sometimes they can lead you to good outcomes. Focus on the projects and the uses of the currencies. So the currencies that you want to invest with, make sure to know what's the project behind it, how are the uses, because the project and the uses will lead to adoption, and bigger adoption means bigger demand means better price, and this could turn positive for you. Follow up on any news and events that could affect the cryptocurrencies in general, and it's never a bad idea to accept losses. Sometimes you see your coin going down 30% and you believe, oh, let's wait for it in order to recover. But maybe it goes 95% down, and this is going to be too late for you to just cash out on the left 5% of your position. This is, for those who do technical analysis, this is the chart, daily chart for Bitcoin since March. We can see how the market is just fluctuating in this. Those who use linear regression with standard deviation could have better chances in order to picking tops and bottoms in the market. And since the beginning of the year, unfortunately, crypto is just trading sideways. Bitcoin is trading sideways between 34,000 and 45,000, awaiting a certain good driver that could just push the market. And it's in either a bullish scenario where the market could be heading into these levels. 52,000 is the key level, and then after 73, or on the downside, a break below 28,000 could just lead to further losses towards 20,000. These are the cryptocurrencies that Exness will offer. Exness is a multi-asset broker, so you can trade cryptocurrencies, currencies, gold, stocks, indices of stocks, energies, all on one platform. We have a couple of platforms that suit you. We are a multi-regulated broker. We are regulated in SISEC and FCA. We have offshore also regulations, and we are going for more regulations in order for you to feel safe when you're investing with Exness. And also, we do provide different trading platforms, as I mentioned. Low and stable spreads, good leverage, no holding costs for cryptocurrencies, and these are the variety of cryptocurrencies that we do offer, or the pairs. So we have almost 27 cryptocurrencies, almost 35 pairs, you can trade them, and this is the barcode where you can scan it and just to get the contract specification, so you can know the contract specification for each cryptocurrency that you want to trade. It's leverage. We offer up to 1 to 400 leverage on Bitcoin and Ethereum, and other coins up to 120. We're talking about Ripple, Solana, Matic, you name it, Dogecoin. So most of these we are offering them, and we are looking forward to expand our offering. The company believes that cryptocurrencies are here to stay. It could be a very good opportunity for some, and especially those who really know about investments. They have proper strategies in order to invest in such mediums. So this is what we offer. I believe time is up. This is all that I wanted to say today. I wish all of you have proper trading, proper investment opportunities. Make sure to always have calculated risks. Never just go after high returns without calculating your risk. This is a very good and important thing to keep in mind. If you have any questions about Exness or about this in general, I'll be at booth number 7 at Exness at the beginning of the Expo. And this is all. Thank you. Thank you.